My name is Liz Ritchie, and I am Head of Tax here at Forvis Mazars. I'm joined this afternoon by George Ligarius, who is our Chief Economist, Zoe Davis, a partner in our private client team, Nick Nesbitt, a partner in our financial planning team, Paul Barham, also a partner in our private client team, Ian Goodwin, our lead partner in employment taxes, and Steve Abbott, a partner in our corporate tax advisory team. So just a few bits and pieces of housekeeping before we start. So for those of you who have joined us in Zoom, and it's good to see the numbers are slowly starting to move up. So that new link has been shared, which is great. If you want to ask any questions, we're going to leave some time, a decent amount of time at the end for questions. If you could use the Q&A box to post any of your questions, any questions you have for the panelists today. And as I say, we'll answer those towards the end of the session. If you're joining us on LinkedIn, if you could please just use the comments section. We're also we're saying we're recording the session and a copy will be made available to you afterwards. So housekeeping out of the way, let's move on to what happened yesterday. So the first female chancellor in UK history, Rachel Reeves, presented her budget yesterday. And do you know, as a female, it was so encouraging, and it was great that she got a tremendous round of applause from the House across everyone. So a really positive moment, I have to say, from my perspective. It was Labour's first budget in almost 15 years, and both the Chancellor and the Prime Minister had basically, since the election, hinted that difficult decisions would have to be made. They were aiming to address a 22 million debt cap, which, as somebody mentioned this morning on one of our local seminars, there were about 22 billion budget predictions as well in the run up to the budget. So in aiming to address her 22 billion debt cap, she announced a 40 billion in tax increases for individuals and for businesses. So today we're going to explore the commitment to 100 billion in public investment over the next 5 years, the adjustments in fiscal rules, the significant tax changes, including the increase in employers' national insurance contributions and capital gains tax rates. Additionally, we're going to talk through the inclusion of defined contribution pensions in inheritance tax assessments, which start from April 2027, and the extended freeze on IHT thresholds. But before we get into the detail of some of the changes, I just want to ask George, just for your initial reaction in terms of the lengthy budget that we had yesterday, both in terms of content, but also length of time that Rachel Reeves spent on her feet yesterday. Do you think this was a surprising budget? And how have the markets reacted so far?
I think the surprise, Lizzie, is more on how much fiscal room this government will require, because it's a lot, and the markets are still skeptical about that. So, but let's pick this up from the top. The OBR gave us better inflation and much better growth numbers. So they project next year's growth to be around 2%. The IMF says 1.5%. And the market consensus is around 1.1, so about half of what the OBR said. Now, markets, it's a good way to to deal with Parliament, but markets don't really look at OBR projections. Okay. Now, what do they look at? They look at taxes, and taxes are a plus for markets. In the sense that there is a fair amount of fiscal profligacy in the world, and governments seem to be averse to making taxpayers or businesses pay for increasing deficits. So they just incur more debt to pay for those deficits. And and so on. So it's a positive signal to markets that a very wide, again, for markets, that's what I'm talking about. For markets, it's positive that taxes are wide. On the other hand, we're looking at 140 plus billion the next 5 years of extended fiscal space to do public investments. Now, the IMF applauded this, and they said, good, we like public investments directed by the state. But markets are more thoughtful because 140 billion is a lot of money. And the question is, where will it, will growth support that? Okay, where will that money come from? Because only a third of this comes from taxes. Okay, so, and markets aren't sure. And to be fair, I'm not sure either, because I see the yield going upwards all day. The yield on the 10-year US Treasury now at 4.16 or thereabouts. So markets are on the fence. And the one thing I have to say is that bond markets are jittery. I think they understand that we're coming towards possibly either a debt episode or even the debt end game itself. So they don't like any experiments. And that's something we experienced with Kwasi Kwarteng's budget a couple of years ago. I think we're back into that place, not necessarily with the UK as a victim, but governments need to be very, very careful how they deal with debt.
So do you think there's potentially more to play out here over coming weeks and months?
I think at least I'm going to reserve my judgment for the next few days. I remember when Lehman Brothers collapsed, first day things were looking good, and then we had the global financial crisis on our hands. So I'll reserve my judgment until at least Monday to make sure that markets weren't really perturbed. But I'm telling you, what may pass today may be revisited by markets in the next few weeks and months, as you said, Lizzie. If there is an episode, they're going to look at who's the weakest, and then they tend to pile on there.
Interesting. Yeah, watch this space. Thanks, George. If we can move on now to some of the actual announcements, I think it was widely expected that there were going to be some changes to several personal taxation allowances. Zoe, Paul, and Nick, if we come to you, from an individual perspective, what were the key changes and how do you see those impacting individuals?
Thanks, Liv. And if I start off with inheritance tax, there were some significant changes in the inheritance tax arena. So the thresholds themselves have been frozen, but what's different is there has been a change to inheritance tax, agricultural property relief and business relief, which comes in from 6th of April 26. Previously, we had unlimited 100% relief. But from 6th of April 26, we'll have a £1 million limit, which is combined for agricultural and business property, which attracts 100% relief. And that relief is then going to be reduced to 50% for any assets over that £1 million mark, which is a real significant change for any mid-market businesses and their owners, and planning before this date in April 26 will be really important. So we need to be thinking about succession plans now and be ready for that change coming in. And to that end, I would be suggesting considering accelerated succession planning, which is, there's perhaps more of an incentive here to hand over businesses during lifetime rather than waiting until death. But where asset protection is a concern, so thinking about potential divorce, for example, this may not be as straightforward as it otherwise could be. You also really need to understand your business or farmland value to determine the exposure that might exist here, how much above that 1 million might be attracting less relief than it otherwise would. And getting a professional valuation would be a really good starting point for planning. So there's going to be some complexity in the detail of the reliefs, but the headline here, it's no longer as straightforward as it once was, where if you've got a business or agricultural property, you just don't worry about it effectively from inheritance tax if you qualify. So we might need to start thinking about using trusts for pre-sale planning, which we always would have done, but thinking about the anti-forestalling and anti-avoidance rules, they really need to be factored in here. So the sooner the better. One other aspect to think about is it's probably appropriate to consider using, comparing the CGT saving from the base cost uplift that you get on death, comparing that to the IHT liability in the long run that now exists on those assets. So the key point is it a time for reflection and updating succession plans where any agricultural or business property relief would otherwise have been due over that £1 million mark? And the final thought I'll leave you with is we need to really consider, if we do have exposure now, how we're going to fund that. So are there any other liquid assets in the estate? Is there life cover? Is there insurance? It really needs some combined tax and financial planning advice here, which is a perfect segue to introduce Nick to talk about some IHT on pension death benefits.
Thank you, Zoe. Very smooth there. Yeah, as Zoe said, the agricultural property relief and business relief weren't the only things to come under the inheritance tax microscope, if you will. And after, I guess, weeks, if not months, of the pensions rumour mill circulating, it actually ended up being a fairly one-dimensional budget from a pensions perspective. We had thought that pension tax relief mechanisms may change, pension contribution allowances may change, tax-free cash entitlements may change, all sorts of things that tend to come out of the closet every year. In the end, as I say, it was one-dimensional, but one-dimensional shouldn't be confused with positive, I don't think, unfortunately. So the big change was that pension funds left on death now will now fall into the scope of inheritance tax, whereas previously they haven't. And for many of our clients, this will lead to a significant change in the tax profile on death. I suppose just to sort of highlight this change, it's important to have a look at the position as things currently stand and will stand through to April 2027, which is broadly no inheritance tax on almost every single pension asset, because most pensions are held in trust. And the only sort of tax on pensions is income tax, and that tends to be dictated to by whether the member dies pre or post age 75. So essentially, death before age 75, the funds can pass to anybody without any real taxation. Death after 75 means beneficiaries pay income tax when they choose to access the funds. So when we sort of heard the headline of inheritance tax is going to now become due on pensions, the first question was, okay, so is there now an element of double taxation? And I guess the hopeful side of our brains thought, well, surely not. You're not going to suffer inheritance tax and income tax. But it does appear that from the consultation paper currently out, that the plan is for people dying after 75, the pension funds will sit in the inheritance tax calculation, albeit they will be exempt if the funds are passing to a spouse. And then the funds will be subject to income tax as well when they are drawn out, again, if the person has died after age 75. So we do seem to be looking at a bit of a reality of a potential double taxation on pensions. And just to really sort of stick the knife in, if you will, it would seem that if pension funds are now going to be included for the purposes of calculating if someone qualifies for the full residence nil rate band, then there could well be a sort of triple tax hit caused by this bringing of pension funds into the IHT net. So having sort of delivered all the doom and gloom around pensions, I suppose a couple of positive points. Ultimately, again, this isn't coming in until 2027. So there's time for planning. And I guess more importantly, there's time for the consultation to go through. We will certainly be feeding into that consultation. And we would hope that there might be some softening of these triple tax impacts. I think just to finish on sort of the wider planning view that we've settled on so far, I think you have to be realistic that the death treatment of pensions was always a little bit anomalous, really. Tax relief on contributions, tax-free growth, and then tax-free on death. It didn't feel right. So there's an element of it was expected to an extent. I think the second point would be that if people do pass away before the age of 75, then pension funds still represent pretty tax efficient assets. So there is still going to be an element of storing up pension funds. but there will be a key pivot at age 75, and I suspect that we'll see a lot more people drawing down on pensions to a much greater extent than we've seen over the last 10 years or so. But as I said, we've got 2 years to really get our heads around this plan and then adjust the wider planning strategies, likely with people turning to the rest of their estates for their inheritance tax planning and relying more on pensions for their original purpose, which is income in retirement. So without further ado, I think I'm passing back to Zoe.
Yes, we're going to talk about capital gains tax. So this was widely speculated to go up, and there were all sorts of rumours about how high it might go. But it was less than anticipated, actually. So the lower rate has increased from 10 to 18, and the higher rate has increased from 20 to 24. The bad news is it's effective from Budget Day, 30th of October, yesterday. So there's general anti-forestalling that applies here for as you would expect. So any unconditional, uncompleted contracts that were entered into prior to this date may still be subject to these increased numbers, opposed to the ones that existed before. So something to watch out for and consider carefully if you've had any transactions straddling this time. A change in carried interest as well. So the capital gains tax on carried interest is increasing from 28% to 32%, and that's effective from 6th of April 25. And then there'll be a further increase from 6th of April 26 there. Again, it was speculated that carried interest might be in the spotlight, so that's not a huge surprise. The annual exemption of £3,000 has been retained, but the overall message here is actually these increases are unlikely to really make people stop transacting, which perhaps was the idea behind it not being too aggressive. There were changes to consider for business asset disposal relief. So this is the relief that means that you can have up to £1 million of lifetime gains, only taxed at the rate of 10%. So this rate is now going to increase to 14% and then 18% from 6th of April 25 and 6th of April 26. So it's effectively not allowing the differential to get too far away from the standard capital gains tax rates. And again, we've got anti-forestalling provisions around this. So just thinking about the timing of when things were entered into will be important to get this reporting right. And also in respect of reorganisations as well. So share for share exchanges, if there were elections in place prior, we would hope they would be okay. But if not, these might need to be considered a bit more carefully.
Thanks, Zoe. There's going to be some interesting computations for the current tax year with the changes midway through the year. Given that the CGT increases have taken effect immediately, what options are there for business owners who are looking to sell at the moment? Yeah, absolutely. Now, the first thing I would start with is, well, business asset disposal relief is still available and even more valuable at the moment up to 5th of April, where we've got that immediate capital gains tax rise, but we don't have the corresponding rise in business asset disposal relief rate. So this could save around £40,000, for example, in 24-25 versus 25-26. So I'll definitely keep that one front of mind. Consider EIS investments and CDIS investments, because they're able to defer or remove the capital gains tax that exists on gains that are arising, so worth considering. The old favourite, spousal exemptions, still exists. So considering between spouses and civil partners and transferring assets between each other, it is definitely one to think about, particularly if one has losses that they can use. Another aspect to think about is where you've got a little bit longer in planning, considering having a holding company above the company you're considering selling. That potentially allows us to benefit from substantial shareholding exemptions, so effectively no tax on that sale by the company. And now we've got this reduction in BPR, in business property relief. It's less of a problem to have an investment company than it was. So I think this planning is really going to be up there for people to consider. I would also add in, consider holdover relief, gift relief for any transactions, and generally I would say more lifetime gifts
for succession planning, where you've got qualifying trading assets, because these may now be exposed to inheritance tax where they weren't before, would be relevant. But it's going to be more nuanced for non-trade assets, because where we've got perhaps 20% inheritance tax, if you're thinking about the 40% exposure that then you get the 50% relief of, so that gets us to 20%, on a market value number where someone passes that down on death, versus a 24% capital gains tax rate on the uplift of the asset since it was purchased, is not a straightforward calculation anymore. So definitely something to work through on a case-by-case basis, but quite a few bits in the kit bag there, I would say, just to pull together and think about, hopefully. So Paul, I now think you are going to talk us through the changes for non-domiciled individuals.
Yes, thank you, Zoe. I feel like I've been talking about this for months and months. So let's maybe pick the story up from the summertime, when the new government announced that they would alter the basis in which the UK was going to tax non-domiciled individuals, and essentially rip up the idea of domicile for tax purposes and replace it with a residency-based system. So yesterday we had some more details which set out what the new rules are going to look like from the 6th of April. That does include replacing the remittance basis with the exemption for 4 years for foreign income and gains, or the FIG regime. That's going to apply irrespective of whether the income and gains are remitted or brought into the UK. So is a real shift, but narrows down that remittance basis window that was for 15 years down to just 4 for new arrivals. Overseas workday relief is extended by a year to 4 years to bring it in line with the FIG regime, really. And it's simplified in the sense, so overseas workday relief is for people who are new to the UK that are working part of the time in the UK, part of the time overseas. One of the requirements under the existing regime was to have that salary paid into a non-UK bank account. That falls away, but there is a downside to the extension of the window to use it, in that the relief is capped to the lower of 30% of earnings, or £300,000. Another IHT change that's particularly relevant: IHT is going to apply to worldwide assets after someone has been in the UK for more than 10 out of the last 20 years. This is worse for many existing non-doms who had a 15-year window, but actually does provide some benefit for those that are from the UK but leave the UK and become non-resident, as their non-UK assets fall out of IHT after being non-resident for 10 years. And it's worth noting that visitors who come for 10, 11 years and fall into that IHT net for worldwide assets, the sooner they leave after that 10-year window, the sooner they fall out of it again. Offshore trusts are something which for a number of years non-doms have used very effectively to manage their exposure to UK tax. And much of the excluded property and protected trust status rules and conditions fall away from April next year. Income and gains of protected trusts will be taxable on the settlor of many of those trusts, and offshore trusts will be subject to UK inheritance tax once the settlor has become resident for 10 years. So whereas that's a real difference. Currently, whatever the position of the settlor is when the trust is established is where we have the key point for inheritance tax. So that movement to the residency of the settlor is a real difference.
Thanks, Paul. Just a question, the new rules offer opportunities for those who are planning to come to the UK or those who've only recently become UK resident. But what about those who've been in the UK for a few years and are maybe now having to reevaluate their plans? Anecdotally, I'd heard in the run up to the budget, it was virtually impossible to book an international removal company in and around London. So just your thinking on that would be interesting.
I mean, again, this year, the conversation, the question has been, should I just up sticks and leave, and how do I go about doing it? And thankfully, I've never got to the point where I've needed to work out the practical arrangements about moving overseas. But A number of people have considered moving. Some of those have then decided against it. And actually, there are transitional provisions for those who have organised their affairs under the existing remittance basis non-dom regime, and we have a few more details of those. So to encourage those that have claimed the remittance basis previously to bring in some money into the UK rather than leave it overseas and join it, there is a transitional provision to come through from April whereby untaxed income and gains that have accrued before the 5th of April can be remitted, can be repatriated to the UK at a reduced rate of tax. Now, this temporary repatriation facility, much easier to say TRF, means that from April 25 until April 27, any income or gains that have not previously been taxed that fall into this TRF regime will be taxed at a reduced rate of 12%, and then 15% for the year thereafter. So this facility will end in April 28. It does mean that you have quite a bit of flexibility. You can pick and choose what income streams, whether it's income or gains each year, and you don't actually have to remit the funds at that time. You just simply have to designate those funds as becoming taxable under TRF. Those impacted, those residency remittance basis payers are also able to rebase their assets to the value in April 2017. So only the gain that has accrued since then becomes taxable.
Yeah, I think as you've said, Paul, quite a lot of non-DOMs and offshore trustees have kind of been biding their time, waiting for the budget to understand how they should proceed. What should they do? So what variations over the next few months?
So I think non-DOMs and offshore trustees have a similar but slightly different action plan over the next few months. Non-DOMs need to confirm, first of all, whether they can qualify for TRF. And that really means that they need to understand if they have not been a remittance basis claimant before, how and whether they are eligible to make a claim. I think it's really important to look at that sooner rather than later, because the remittance basis charge that applies increases the lot for the as the number of years of residency pass. So being able to amend a remittance basis claim for an earlier period may mean that that charge is lower. So looking at that sooner rather than later, I think, is the initial first step. Then, of course, we come on to what do you claim relief on? And understanding what foreign income and gains somebody has that they've not paid tax on, and understanding what foreign income and gains could be realised before the 5th of April becomes the second part of that plan. It will be important that if income and gains are being realised now, that that person still qualifies for the remittance basis, and a remittance basis claim is made for 24-25. And it's also quite important to make sure that they don't trigger an accidental remittance before the 5th of April, because that would be subject to the full rates of tax and not the 12%. As I say, offshore trustees follow a similar pattern. Understanding what income and gains should be realised before the 5th of April 25 and what should be distributed are really important. But taking a thorough review of how the changes will impact the trust more widely, there are some quite complex rules about the settlor's position being intrinsically linked to the trust, and where the beneficiaries are, how they would be taxed also becomes really important. I think the TRF will provide opportunities to many trusts to consider whether winding up and capping a liability to tax at that low rate is worthwhile. That needs to be carefully considered, not least because our existing offshore trust legislation is really quite complex. And we've found in the document that was published yesterday, there's quite a lot of adjustments to those anti-avoidance provisions already that sort of unravel the pathway through. I definitely think offshore trustees need to start thinking carefully about a revised strategy, not just for this interim period and this transitional period, but for the longer term benefit of the trust.
Thanks, Paul. There's a lot there. I mean, that's just on an initial kind of taking in what was said yesterday and an initial review of what's, so there is a lot there you see coming through. I think we're going to take a slightly different tack now and talk a little bit more about how the budget yesterday impacted businesses. So going to come to you, Ian, first from an employment taxes perspective. So obviously the kind of the big talking points have been around national insurance and national minimum wage and the changes there. So what do the changes just mean and potential opportunities there?
Yeah, thanks, Liz. And these have been headline news for probably the past month or so, particularly around what was going to happen with national insurance. We had rumours stating that they might put employer national insurance on pension contributions. Fortunately, that complexity didn't come to pass. But what they did do was they did increase the employer rate of national insurance from 13.8% to 15%. Alongside that, they've also reduced the earnings threshold at which you start paying employer national insurance on employees' pay, and that's gone down to £5,000 from 9,100, and that will come in from April 2025. In practical terms, I'll stick with the threshold first. That means that for every employee you employ and pay, assuming you're paying them, let's say, a full-time rate, it will be £615 in that reducing it to 5,000, that 4,100 that you will now be paying in extra NI without even considering the additional 1.2% on top. So this is going to be a significant cost for businesses. Separately, you've got the national minimum wage rates, and they were officially announced the day before the budget. And we've seen increases there of between 6.7% for the national living wage, i.e. the rate for those aged 21 and over. That's going up from £11.44 to £12.21 to the biggest rate change for the apprentices and those under 18, which is going up to £7.55 from £6.40, which is an 18% increase. So there's increases all around there, which means that when you've got an increase of national minimum wage, you've got more national insurance to pay anyway, regardless of the 1.2% increase. You've also got more employer pension contributions to pay. So there's a lot more cost pressures being put on the business. We had a seminar in Leeds earlier today. One of the examples we threw around was where you had 10 employees that were on the national minimum wage at the moment, full time. You'd be paying around £265,000 of salary costs with pension and national insurance at the moment. Come April next year, that'll be around £292,000. So it's going to be a significant increase. You've got to think, how many more products do you have to sell to keep that going? And where can you make those potential savings here? We then looked at savings and opportunities. So where are they? Well, in some senses, there's not lots of options here, but what was good with respect to the fact that the government did not go down the route of putting national insurance on pension contributions is there is still an opportunity to implement salary sacrifice for pensions, bonus waiver arrangements, providing that we're not taking people below the minimum wage there. So that's going to be something to look at. Alongside other things for certain sectors, trunk arrangements for the hospitality sector, making sure you can pay tips and gratuities compliantly without having to put national insurance on them. That's going to be important. As is also looking at how car allowances and mileage reclaims are done too, to make sure national insurance is being paid on the correct amount there. And we've been helping lots of organisations with that. So there's quite a lot to consider there. And there are some opportunities to save elements too elsewhere. So by that I mean, how do you engage workers? Can you engage more apprentices in your organisation, given that apprentices under the age of 25 do not have employer national insurance on their pay, assuming they're not getting paid more than £50,270 a year. So there are some other elements to look at here alongside thinking, wow, we've just got lots of costs. Let's have a look. Let's see what we can achieve and plan for.
Yeah, it's interesting, certainly in what we've seen overnight, and then I suppose the breakfast news bulletins this morning, that probably the biggest reaction so far has been from a lot of those small business owners who are just at the minute digesting the cost impact for the business.
Yeah, I think we did a row of hands, this morning, and some were saying it's going to cost an extra 50,000, some it's going to cost an extra 250,000. One person was an extra million. It is
Wow.
significant. And where do the only place you can go to is, can you put that cost elsewhere?
Yeah.
And you
Yeah.
make savings somewhere, and there's not a lot of options in reward. You're tinkering around the edges, I would
Yeah.
say, and you've still got to try and have a attractive reward package to make people want to stay with you and make people want to join you.
Absolutely. Are there other things, Ian, that businesses need to look out for just on the back of yesterday?
There was things in the small print in the detail. So obviously the main events were the national insurance and the national minimum wage. But one of the aspects that I have written about before is double cab pickups. It seems a very niche topic, but double cab pickups that are over 1 ton in payload weight are treated as a van currently. The previous government tried to treat them as a car, and that got kiboshed in sort of February, March time earlier this year. That is now happening from April 2025. There are some transitional arrangements, but those people with a Ford Ranger, VW Amarok, Nissan Navara, it's those types of vehicles that will be treated as a car for benefit in kind purposes. And that could bring with it some significant tax increases for those individuals, given the differentials between van benefit in kind and car benefit in kind, particularly when you bring the private fuel benefit in as well. So it's a bit niche, but it does impact a lot of people that are business owners, because they do like a double cab pickup, I find, particularly around Yorkshire. The other bit that was probably more broader for everyone is payrolling of benefits. Obviously, we've not heard much about that recently, because we've had a change in governments. We've had HMRC think, well, can it be mandated from 2026? There are things to do. In the small print yesterday, it did stress that they are still looking to mandate it from 2026. We've done a number of seminars recently with other organisations on this. It is not straightforward to do. So I do stress that people take their time to plan this. So do not try and rush it. It's not just tick a box and put it on the payslip. There are lots of things to consider. What happens when people go on maternity, parental leave, sick leave, when they've got no pay? How does it interact with salary sacrifice? How does it interact with other benefit values? So we've been helping organisations make sure they can plan and communicate it and get it all set. There are still some benefits you cannot payroll from 2026, and those will be loans and that will be accommodation so far. But we'll await extra updates from HMRC. As I said, the government has just reasserted its position there. We don't know how HMRC will plan for that, given it can take some time to get software updated. We do know that they are trying to recruit more people into HMRC to both look at compliance. So things like IR35 with the umbrella update as well yesterday, when they're going to be looking to pass that to basically the end user, the agency to some degree, but also, making sure that people are doing the right thing for national minimum wage, R&D and other purposes. So we will see more scrutiny of organisations as part of investment by the government.
Yeah, I see that. I think, that whole kind of progression on payrolling benefits and whether they will be ready is similar to making tax digital for individuals, which we've obviously been talking about for some time, and still to have it delivered. So I suppose it is a case of watching this space, I think.
Yeah. So the last thing just to update is on the electric vehicle position. Obviously, at the moment, we're in a 2% benefit in kind rate for wholly electric vehicles. That will go up to 9% in April 2029. Now, there is some time off. You probably, people have a few vehicles by then, but the line of traffic is to increase it over the next number of years. And that's also the case for hybrid vehicles, and they will be going up to 19% from April 2029. So that's going to be something to really look out for, regardless of their mileage range. So be careful with what you're doing from a vehicle fleet perspective, but it may still be more affordable to have a company car rather than get one yourself. You'll need to think how it interacts with mileage at 45p a mile versus the 7 or 10 or 11p that you can get. So we're doing quite a lot of exercises for that for organisations too at the moment.
Thanks, Ian. The budget, I suppose, yesterday was fairly light, I think, on business tax. But there was, obviously the employment tax piece that we've just covered was a key factor. But Steve, from your perspective, do you want to just give an overview on what was said yesterday from a business tax perspective?
Yes, thanks, Liz. And I think I'd completely agree with that, in that Ian's got the headlines from a business tax perspective in terms of what he's talked about already. And then moving to corporation tax, I think to a certain degree, shall we say, it's a case of no news is good news. I mean, what was announced was the introduction of a corporation tax roadmap. And that's welcome because it confirms that there's not going to be any major changes to the corporate tax regime. It commits to a cap on the corporation tax rate of 25% in this Parliament, gives security around the basic structure of the tax system, and gives some certainty to business about the direction on CT. From an international perspective, just to briefly touch on that, the roadmap confirmed the Pillar 2 reforms and also a consultation on transfer pricing that could contain some good and bad news from that perspective. So that's something to keep an eye on. The full expensing for capital allowances has been preserved. Innovation reliefs have been preserved and committed to. So R&D tax credits and patent box for this Parliament. And there's been some simplification and guidance issued on those innovation reliefs and capital allowances. So that's really welcome. And we'll go, I think all this will go to help mitigate some of the difficulties caused by the raft of changes in corporate tax in recent years.
Yeah, thanks, Steve. We do like a roadmap, don't we? In tax, we do like a roadmap. So this proposed stability, which we hope that the CT roadmap is going to give us, does it provide, do you think, does it provide the basis for investment into the UK? Do you think there's enough there?
I think it's a good starting point. And I think we'll all have probably heard quite a lot of commentary in recent years that a stable tax regime is as important as a low tax regime in terms of encouraging international investment into the UK. So yes, I think to a certain degree, it is a positive. The warning bell that I would sound, though, is I think when you're talking about a tax regime, you are talking about all taxes. You're not just talking about corporation tax. So the big change that Ian's just talked through, and to some extent, some of the changes that Paul and Zoe have talked to as well, all have an impact on that overall view on investment into the UK. So it's a little bit of a watch this space and let's see what happens over the next few years.
Yeah, I completely agree, Steve. I mean, I think if you're, the owner of a business, the tax position from the corporate linked to your own personal position, they're all inextricably linked. So ultimately, there could be an impact across the board. What about HMRC then? There were some announcements yesterday about increased HMRC compliance activity. Do you want to share some of that?
Yeah, so I think they're going to increase the number of staff, or recruit a number of staff in debt collection and compliance. The exact specifics aren't known yet, but it was stated in the budget that that's intended to raise £6.5 billion by 29-30. So that's a huge amount. So we'll have to see what that means, and potentially means a big burden on the business sector. One specific thing I noticed was there is a 1.5% increase in the interest paid on late paid tax from April 25 next year. That's quite a significant rise. And just to try and bring that to light, a lot of companies listening to the webinar today will pay their corporation tax by quarterly installments. They'll probably have experienced a fairly relaxed regime where if they've underpaid, they catch that up with some interest payments down the line. But actually, the cost of that is going to increase significantly from April. So you probably want to reassess that against the cost of capital that you have in the business to make sure whether you might want to pay a bit more in advance in relation to that. And I think the other thing to flag, it's not just corporation tax. This is late paid tax, pretty much across the board. So, it applies to lots of things like unincorporated businesses or even partnerships who have to pay tax on estimated profits with the partnership reforms that we've just seen. And then one other last thing I noticed, a lot of people on the call will be aware that R&D claims have been in HMRC sites in terms of compliance activity in the last few years. And it was commented on, it did come out yesterday, that actually the amount of SME claims has reduced by 23% in the most recent year. So that is showing that compliance activity is having a real impact on SMEs making R&D claims. There's loads of other little things, but I've probably not got time to cover them today.
No, that's okay. It is interesting. She did just throw in the additional increase to tax paid late, and I was just thinking that about that in the context of basis period reform for professional services organisations. There will be an impact there. So lots of bits and pieces in the detail, and I think there's probably it was just yesterday. There's still a lot more to do in terms of the analysis of that detail, what the potential impacts might be, and then what potential opportunities might still be there. Moving on, I'm just going to open the question section. So just bear with me a minute as I move. There's a few questions here, Nick, from, I don't know if you've had a chance to look at them from a pension perspective. I looked at the pension IHT consultation document and concluded that there will be IHT and IT on beneficiaries. Do you think there's scope for companies to object to this and bring about change? And then there's another one in terms of what is the third implication on pensions in addition to income tax and IHT?
Yeah, I think that question was asked in two very similar forms.
Yeah,
so
it was.
I'll take the first one about the consultation and our response to it. We certainly will be providing a response to the consultation and giving our thoughts. I mean, I'd love to be hopeful that we might be able to convince the government not to apply double taxation, but I think the problem comes that the majority of pension funds will still pass on without the deduction of inheritance tax. Ultimately, I think the consultation talks about only 10% of estates actually suffering inheritance tax. So if they were to do away with income tax on pension death benefits, I don't have the stats to hand, but anecdotally, I would imagine they would give away more in income tax than they're raising in inheritance tax through this measure. So again, we can be hopeful, but I wouldn't be too hopeful. I would expect that we will see the double taxation that is suggested in those examples in the consultation document. Going on from that to the triple whammy of taxes. So the third one that I sort of rushed fairly swiftly through was, with inheritance tax, everybody has a nil rate band of 325,000, and then certain people are also given a residence nil rate band of 175,000 to give individuals a total allowance, if you like, of £500,000 that can be passed on tax free. However, there's some conditions that apply to the £175,000 residence nil rate band. And a key one here is that your estate doesn't exceed the £2 million in value. Now, historically, that estate has excluded pension funds because pension funds have been outside of the estate. All of the wording in the consultation would lead you to conclude that pension funds will be included in the estate for the purposes of calculating if an estate is entitled to that residence nil rate band. So, cut a long story short, what it does is, if the pension fund effectively adds to the estate and leaves you with an estate of over £2 million, you will suffer some inheritance tax effectively at 60%, and then income tax on the residual 40%. So it's a bit of a sting. I think we probably will be lobbying that the pension funds aren't included for the purposes of the residence nil rate band calculation.
Thanks, Nick. Thanks. Paul, there's quite a specific question here around a UK citizen living in the UK more than 30 years. Mothers in the US, a US citizen, got a living trust that sees grandchildren inheriting 10% of the estate. the US taxes the estate at death, then what is passed to beneficiaries is considered taxed, and so inheriting assets from a tax US would not be subject to UK inheritance tax. Has the budget changed this? And will the children's US taxed inheritance be taxed again in the UK?
So the budget, I don't think has changed for this scenario. I think the living trust means that for UK tax purposes, we're not considering it to be a trust and still part of the mother's estate. So it would be received in the UK after tax had been paid by the estate in the US. I think this is a really good question and a really good example, though, of there's a little bit of danger in presuming that the trust in itself isn't taxable in the UK, because then that means that we have the series of matching provisions, the distribution provisions to consider, which all have altered in the changes announced yesterday. So I suspect the answer may end up being there's no change, but I don't know if I would feel comfortable making that presumption.
Yeah.
We'll probably want to refresh the understanding of how that trust works in the UK.
Yeah, I completely understand that. Just actually coming back to pensions again, Nick. There's a question here around, from an inheritance tax perspective, would it be beneficial to extract all pension funds accumulated from available pots, gift it to beneficiaries as cash, and then effectively try to live for 7 years?
That's certainly where the mind jumps to, I think, so hopefully we've sort of given a feel for the fact there's going to be this pivot, really, that up until age 75, you might hold tight and think, well, if something happens unexpectedly, then at least I've won that battle, so to speak. But then after age 75, you've got a problem in that you've got a pension fund that's going to be very heavily taxed. And then you'd start to draw out quite quickly. So I think there is going to be a complete rethink of that pension drawdown strategy. Whether it's ever going to be strip the whole thing out, suffer tax at what will be 45% for most people, or considerable amount of it, 45%, and then gift it, I'm not sure. The mind sort of starts to think more around potential increasing drawdown, doing something under the gifts and out of surplus income exemption, possibly looking at annuitization of pension funds, and then that giving you the security of income to do other things with other assets you might have. It might be some insurance-based solutions that we can look at. But I think in principle, yes, there's something in that question. I think few people are really going to be prepared to take that big tax hit in one go.
I agree. I mean, certainly immediately you start thinking about, and maybe not to the same extent, but gifting, and a planned kind of pattern of gifting certainly becomes really quite attractive again. A question for either Zoe or Paul, whoever wants it. Invested in commercial forestry, is that caught by the agricultural property business relief changes, or does that still stay as is?
So I would expect if it's qualified for APR or BPR under the existing rules, it is going to come within this £1 million limit that is coming into play. So how that £1 million is split across your assets, if you've got, it depends on the numbers, but you would have to split it if you've got something that qualifies for agricultural, some for business property. But in short, yes, we've got this £1 million limit that applies across your assets.
There is one question in the chat which I will come back to and get an answer to that. It's a question in relation to VAT on private school fees, and I have to confess we do not have a VAT expert on the call today. So Debbie, I think you've asked that question. I'll make sure that you get an answer to that after the call. I'm not sure anyone on this call would thank me for giving them that question to answer, so we'll follow up with an answer to that if that's okay. I just wanted to say thank you very much for joining us today and for bearing with us in terms of our technical difficulty. If you'd like more details on anything that we've covered in today's webinar, please get in touch with your usual contacts or on our website. As we said at the beginning, a recording of the webinar is going to be made available on our website, and a copy will be sent to everyone who signed up. Happy for you to share that with your colleagues. You might also be interested in our next webinar on the economy and investments, which is taking place on the 27th of November. George will be speaking and will have had another 3 weeks to further digest the contents of the budget. He's also going to be joined by Ben Seeger-Scott, who's our Chief Investment Officer and Head of Investments in the UK, just for a discussion on global economy, inflation, interest rates, and the investment landscape. So the link to register for this event in the chat box just now, and it will be in our follow-up email following today. So thank you so much for joining us today, and enjoy the rest of your afternoon. Thank you.